welcome in Aditi Nayar joining us from ICRA. Aditi, great to have you with us. The RBI is bringing many a surprise today, primarily the dovish stance. Take us through what you felt were some of the key takeaways.
Thank you. Today was an interesting day. As far as the stance and the rates were concerned, we were not surprised at all. We were expecting a complete status quo, no change in the monetary policy stance, no change in the repo rate and no change in the reverse repo rate, and that's exactly what we ended up getting. However, as you pointed out right now, the tone of the policy was a lot more dovish than what we were expecting. We thought this was going to be the last status quo policy, but I certainly now expect April to be another status quo policy, going by some of the commentary that's included in today's MPC statement. As expected, growth has been described as the growth recovery as incomplete and not yet broad-based, and that continuing policy support is warranted to be able to sustain and make the growth recovery more durable. But I think more so on the inflation side, there is an expectation that the MPC has conveyed that the inflation will peak out in the current quarter and fall after that. So as far as the trajectory is concerned, I would agree, but our own estimates of both the growth recovery and the inflation rate for FY23 are a little different from the RBI. We're expecting a higher growth in FY23. The RBI MPC's estimates of growth in H2 seem to be quite modest at 4.3% in Q3 and 4.5% in Q4, which is really quite muted. And perhaps that is something that they expect will contain any pass-through of higher commodity prices into final output prices, and therefore their inflation average estimate for FY23 at 4.5% is also a little lower than our own estimate of 5% with an upside.
And that's just what I was going to ask you, that, what are your estimates looking like? What's the kind of range one's expecting crude to hit or trade at this point of time? And what is the likely glide path of inflation going forward if we put aside what the, what the policy has sort of kept into account for today? They're also sounding incredibly dovish, even going ahead for the next couple of meets in terms of what they're indicating.
Absolutely. So, in terms of the outlook, we had thought that after a complete, status quo today, we're probably going to get a change in the stance and an increase in the reverse repo rate in April. Now we think that's been deferred by one meeting. So effectively now we think, going by today's commentary and tone, we're more likely to get a stance change and reverse repo hike in June, and then two repo rate hikes of 25 basis points each in August and October. So we basically push forward our policy normalization expectations by one meeting each for each of these changes. On the growth side, we have a slightly lower forecast for FY22. We expect growth to be more back-ended. And so for FY23, we're looking at a 9% growth, which entails about a 5.5% to 6.5% growth in the second half of the year. This is where we differ significantly from the MPC's forecast today, where they're actually penciling in a 4.4% GDP growth in the second half of FY23. So that's, a significant deviation. On the inflation side, the average that the MPC has indicated today is 4.5%. We expect it to be closer to 5% because we do think that once demand revives, producers will pass through the recent rebound in commodity prices. So I think that's where the main difference lies. But in terms of the specific items like monsoon, for example, the MPC has assumed a normal monsoon. Our view is that even if we don't have a normal monsoon, because we've had a healthy volume of rainfall for the last several years, although the actual distribution has been uneven. So the likelihood of getting another year of normal or above normal rainfall does seem to be a little low. But having said that, our reservoir levels are very healthy right now, and at least that mitigates against the negative of getting a potentially subpar monsoon rainfall. So I don't have too much of a concern on the food inflation side. On crude oil, I do agree that the current levels have been pushed up by the geopolitical tensions, and I don't expect crude oil to sustain at these levels for a prolonged period. They may stay at these levels for a month, 2 months, 3 months. It's really difficult to say how long this is going to continue. But eventually, I do expect crude oil levels to at least come back to what we saw in early January. That seems to be a more sustainable level given what we understand about the global demand. Supply side issues, of course, are a growing concern in terms of the limited investment being made by some of the global fuel companies, etc. But demand has to hold up as well, and we don't think these levels are sustainable for too long.
Aditi Nayar, thanks so much for joining us and taking us through the implications of the policy meet this time around. Incredibly dovish, but as Aditi says, in line with what they anticipated on repo and reverse repo. Let's take a very quick break. On that note, we'll come back with the other big newsmaker of the day, and that's the LIC IPO. More on that when we return.